Hello everybody and welcome back to another video. So I know you guys might be a bit confused by the title of this video and the thumbnail, and yes, maybe the market might not be overvalued. I know everywhere you hear that the market's overvalued, everybody says the market's overvalued, and I thought that for many months. But recently I had a bit of change of heart on the market's valuation, and in this video I'm going to explain to you why I think the market might be fairly valued. Let's get into it. So when you look at PEs, the market does look quite richly valued because generally when it gets around like 25, it doesn't stay around the PE of 25 for long. Like, it usually crashes a lot historically, as you can see. And you might say that the reason why the PEs are high is because of low rates. But that's the thing, rates change. So if the rates were low, which they obviously are, I mean, we're at 0% interest rates right now, the market would be overvalued. If that was the reason why the market has such a rich valuation, low rates wouldn't stick around forever, right? So eventually the rates would get increased again and the market would kind of come back down to earth in terms of PEs, right? But I want to explain to you my opinion on why we might never see a market that has under a 20 PE ever again. Let me show you why. So now, my reasoning on why the market might actually be fairly valued these days is because market valuations in general are changing. Because for many years, the markets were not very tech heavy. Like, most of the big index funds were run by companies like, I don't know, Pepsi Cola or something, right? Which don't grow at all, which have no growth, which are just stable, low PE, which is why, the market generally has quite a low PE. But these days, the market is pretty much entirely based on tech stocks. Like, if you look at the S&P 500, which is like the most famous index fund, it has 505 companies in it. I know, not 500, which is a bit weird, right? But it has 505 companies on it. And 5 companies, Apple, Microsoft, Amazon, Facebook, and Google, make up 22.3% of the whole index. There are 505 companies in the S&P 500, and over 22% of this index is made up by these tech companies. So now what does that mean? All these tech companies, because they are relatively high growth still, and because they have such a high weighting on the S&P 500 index, as an example, and pretty much all the other indexes are very highly weighted on these 5 tech companies, right? Because they're high growth, that also means they have a high PE, which means that the whole market has a high PE. So even though the market looks richly valued right now, it's going to continue to be richly valued probably forever, because tech companies are going to become more and more prevalent in all these indexes, right? So if you look at it, just a few months ago, in January of this year, these 5 companies were 17.5% of the S&P 500. Now, this was updated on September 4th, just as a PS. So it's quite recent. This is quite recent data, right? And now, these companies have a significantly higher weight on the S&P 500 than they did only a few months ago, which is crazy, right? So basically, what COVID did is that, yes, it caused PEs of the whole market to go higher. The reason for that, though, is because, in general, a lot of companies took a strong hit in their profits, right? But a few tech companies still did well during this period, so their stock went up. So basically what happened was that 5 tech companies, for the most part, caused the market to get sort of an overinflated look because of a high PE. So what this means for the future, right, is that you're not going to be seeing the S&P 500 index most likely under a 20 PE ever again, in my opinion. I don't think it's ever going to happen again. Maybe it might happen once or twice during a sort of blue moon event, but in general, I expect the S&P 500 to now have above a 20 PE, and tech companies as a whole are just going to be a bigger and bigger part of our daily lives and of the stock market. There are some other options for people who want a index fund that is more balanced. I will in a second show you an index fund that is for people who want an index more diversified, that's not quite as tech heavy. So here it is, the S&P 500 Equal Weight Index. This index basically has the same amount of weight in small and large companies in the S&P 500, which means that this index is not dominated by a few tech companies. So for those index fund investors out there, this might be a good option for you, the S&P 500 Equal Weight Index. And lastly, I'm going to finish off this video saying that this is all just my opinion. You could have a different opinion, thinking that the market might be overvalued, and I'm completely fine with that, because this is just a relatively opinionated video backed up by some facts. But really what it is it's my opinion, and you should always formulate your own opinion when going into the stock market. And if you enjoyed this video, please consider leaving a like and subscribing to my YouTube channel for more content like this. See you later. Peace.